Okay, so like imagine this, you're, you know, just chilling, checking your investments, having some coffee, and then suddenly, bam, predictions of like really dismal returns for the next decade.
Yeah.
I mean, talk about a mood killer, right? Makes you want to just like stuff your money under the mattress.
Oh, yeah. It's definitely not the news anyone wants to see, especially after the market growth we've had recently.
Totally.
So, yeah, it's understandable that people are kind of freaking out a little.
Exactly. And that's exactly the kind of buzz that a recent Goldman Sachs prediction has caused.
Uh-oh.
Yeah, they're saying we might only see a measly 3% annualized return from the stock market over the next 10 years.
Wow.
That's pretty low, and it has a lot of people questioning if stocks are even worth it anymore.
Yeah, 3% is definitely a significant change from what we've been used to. And yeah, of course people are concerned.
Right.
But before we all abandon ship and start, burying our savings in the backyard, let's really take a deep dive into what's behind this prediction. We'll unpack, Goldman Sachs' reasoning, see if it actually makes sense, and most importantly, explore why this might not be the disaster for your portfolio that it seems.
All right. Sounds like a plan. So we've got this CNBC article here that analyzes this Goldman Sachs forecast, and they seem to have zeroed in on 5 key factors that led to that 3% prediction.
Okay, let's hear them. What's got Goldman Sachs feeling so pessimistic?
Well, first up is valuation, the S&P 500, which is kind of like, the benchmark for the overall market is trading at what they call a high multiple.
Okay.
Basically, I mean, stocks are expensive right now.
Yeah, high valuations are definitely something to keep in mind. It means investors are really counting on future growth to justify those prices.
Right.
It's like buying, the hot new gadget.
Yep.
You're willing to pay a premium for it, but it better deliver on its promises.
That's a great analogy.
Yeah.
Next up, we've got this thing called market concentration.
Okay.
And what that means is that a small group of mega cap tech companies, those giants everyone knows,
Yeah.
they have a huge influence on the entire market.
Ah, yes, the power of the tech giants.
Right.
It's true. They've seen incredible growth,
Yeah.
but it makes you wonder, can it really go on forever?
Well, Goldman Sachs seems to have some doubts.
Hmm.
And they also bring up concerns about profitability, suggesting that future corporate profits might not be as strong as they have been in the past.
Yeah, that's a critical point. I mean, at their core, stock prices are driven by how much profit companies make.
Right.
So any slowdown in earnings could definitely put a damper on things.
Okay. And then there's the elephant in the room, interest rates.
Oh, yeah.
Rising interest rates can make other investments like bonds look a lot more appealing than stocks.
Right.
Potentially leading investors to pull money out of the market.
Because bonds become comparatively safer and more attractive, when they offer decent returns.
Yeah.
So investors might be less inclined to take on the risk of the stock market when they can get a decent return with less risk.
Makes sense. And lastly, there's the wild card economic contractions, or better known as recessions. We all know they happen, but predicting when is like basically impossible.
Totally.
Goldman Sachs is factoring those potential downturns into their outlook, which, is reasonable.
Right. Recessions are definitely a risk factor, and they can really shake up stock prices.
Yeah.
So any long-term forecast has to consider those economic bumps in the road.
Okay. So those are Goldman Sachs's 5 reasons for their rather pessimistic outlook. But hold on, because this CNBC article doesn't just take Goldman Sachs' word for it.
Oh, good.
They present some pretty convincing counterpoints, saying, hey, don't hit the panic button just yet. Goldman might be missing part of the picture.
Okay, I'm all ears. I always like a good dose of balanced perspective.
Of course.
So what arguments do they make?
Well, they tackled the valuation issue head on,
You're right.
saying, sure, the market might be expensive.
Yeah.
But those high valuations could be justified by the strength of those companies.
Okay.
It's like buying a house in a fantastic neighborhood with all the bells and whistles.
Yeah.
You're willing to pay more because you're getting more right.
Right. That makes sense. And it speaks to the idea that investors are often willing to pay a premium for companies that are leaders in their fields and have a clear path to future growth.
Yeah.
They're betting on the long-term potential.
Exactly. Next, they address market concentration.
Okay.
While they acknowledge the big tech companies' influence, they point out that their success isn't just luck. They're delivering results. They're innovating, and they're adapting to change, which is why they're so dominant.
Yeah. It's easy to focus on the size of those companies, but we can't forget that they got there for a reason.
Right.
They're generally pretty good at what they do.
Now remember, Goldman's concerns about future profitability. Well, CNBC highlights a potential game-changer technological advancements, specifically AI.
Oh, yeah.
They argue that AI could actually boost efficiency and profits, across many sectors.
Now, this is where things get really interesting.
Right.
AI has the potential to revolutionize just about everything.
Totally.
Healthcare, manufacturing, even how we shop and do business. If it lives up to the hype, it could be a massive driver of growth, potentially blowing Goldman's predictions out of the water.
It could turn everything upside down.
Right.
But it's not all about AI. The article also reminds us that the Federal Reserve is likely to lower interest rates.
Okay.
And when safer investments like bonds become less attractive, guess what looks better? Stocks.
That's a crucial point because investment decisions are all about weighing your options.
Yeah.
So when interest rates fall, stocks often become the more appealing choice, even if overall market growth is expected to be slower.
And if that wasn't enough to give us some hope, the article points out that the current economic outlook is actually more positive than many predicted.
Oh, wow.
Plus those recessions that everyone's worried about,
Yeah.
well, they're notoriously hard to predict.
The economy is a complex system, and trying to forecast it with perfect accuracy is like trying to predict the weather months in advance.
Oh, yeah, for sure.
It's wise to be prepared for downturns, but we shouldn't let fear drive our decisions, especially when the current economic data is relatively healthy.
So based on all these counter-arguments, CNBC is basically saying, hey, don't get lost in the doom and gloom predictions. Instead, focus on the fundamentals of individual companies.
I like that.
It's about looking at the trees, not just the forest.
Exactly. In the long run, a company's success boils down to its ability to generate profits and create value for its shareholders.
Yeah.
So focusing on those core fundamentals can help investors navigate the inevitable market swings and make smarter decisions.
And speaking of looking at past trends, here's something really interesting about saying. Remember that 3% annualized return Goldman Sachs predicted.
Yeah.
Well, back in 2017, they made a similar prediction about low returns. And guess what? Since then, the S&P 500 has more than doubled.
Wow.
Yeah.
It's always good to remember that past performance doesn't guarantee future results.
Right.
But it is a reminder that these long-term market predictions should be taken with a grain of salt, especially when they're looking a decade ahead.
A giant grain of salt, maybe even a whole salt lick. But this brings up a crucial question, especially if we are potentially heading into a period of slower growth. How do we protect our investments and still make decent returns?
That's where things like dividends and high-yield investments can become really valuable tools in a potentially slow growth market.
Yeah, okay, now you're speaking my language. I love a good dividend story. So break it down for us. How can focusing on dividends and high-yield investments help us weather this potential market storm? So we're looking at potentially slow market growth,
Right.
but you're saying dividends and high-yield investments could be like our secret weapon.
Exactly. Think of dividends as like a little bonus just for being a shareholder.
Yeah.
Even if the stock price itself isn't, skyrocketing, you're still getting paid just for owning those shares.
I like that.
It's like a regular paycheck from your portfolio no matter what the market is doing.
I do love getting paid, especially when it's for basically doing nothing.
Exactly.
And you mentioned high-yield investments too, right?
Yes.
Like certain types of bonds or real estate investment trusts.
Exactly. These types of investments generally aim to provide a steady stream of income, and they tend to be less volatile than stocks, which can be a nice relief in uncertain times.
So if this Goldman Sachs prediction is making you feel a little queasy, it sounds like shifting some focus to dividend-paying stocks or high-yield investments could be a smart move, especially if we're in for a period of slower overall growth.
Yeah, it's all about adjusting your strategy to the current landscape. And this brings up another important point, diversification.
Okay.
Instead of putting all your eggs in one basket, spreading your investments across different asset types, different industries, even different parts of the world can create a safety net for your portfolio.
That makes sense. It's like having a team of athletes instead of just relying on one star player.
Right.
If one part of your portfolio is lagging, others might be thriving.
Exactly. Diversification helps to manage risk. If one sector or asset class is underperforming, others might be doing well, which helps to smooth out the overall returns of your portfolio.
So even if the next decade doesn't bring those like crazy high returns we've seen recently, by focusing on dividends, high yield investments, and spreading our risk, we can still potentially come out ahead. It's about being strategic and adaptable.
Absolutely. Remember, investing is a long game, and being able to adjust to changing market conditions is crucial for long-term success.
Speaking of adapting, earlier we talked about AI and its potential to really shake things up.
Yeah.
You mentioned it could even like throw a wrench in Goldman Sachs predictions.
Yeah.
I'm really curious to hear more about how you see AI playing out in the market.
Yeah, we're talking about more than just, fancy gadgets and self-driving cars. AI has the potential to fundamentally change how businesses operate, how we interact with technology, and even how we solve some of the world's biggest problems.
Yeah, it's mind-blowing when you think about the possibilities to personalize medicine,
Mhm.
more efficient supply chains, even creating entirely new industries we haven't even imagined yet.
Right.
It feels like we're on the verge of something huge.
The pace of innovation in AI is incredible. It seems like every day there's a new breakthrough.
It does.
And this constant progress is what makes me wonder if Goldman Sachs might be missing a big piece of the puzzle.
You mean because their predictions don't seem to fully account for this potential wave of AI-driven growth?
Exactly. While they acknowledge AI's potential impact, their analysis seems to be more focused on the near-term challenges, valuations, interest rates, and the like. It doesn't feel like they're fully grasping the long-term growth that AI and other emerging technologies could unleash.
It's almost like they're trying to predict the future using an outdated map.
Haha, yeah.
The landscape is changing so rapidly, and those changes could lead to incredible opportunities that are hard to even imagine right now.
That's a great way to put it, and that's why it's so important to stay curious, informed, and adaptable as an investor.
So bring it back to our main discussion. Even if Goldman Sachs is right and we're in for a period of slow growth, it sounds like there's still ways to navigate it successfully. It's about choosing investments, wisely focusing on things like dividends and high yield, and always keeping an eye on the horizon for those emerging trends that could reshape the market.
Well said. The stock market is a constantly evolving beast. By staying informed, diversifying your portfolio, and being open to new possibilities,
Yeah.
you can position yourself to weather any storm and come out ahead in the long run.